Hey everyone, Cullen Haynes here. Welcome to Lawyer Lending Live. And my guest today has a wealth of experience. Lawyers, barristers, partners, or any professional will get value from him. Over 8 years in the experience, long time working with global banks. I think you're going to really enjoy John Walker, who is joining me now from Optimal Wealth. How are you, John?
Yeah, great. Thanks, Cullen. This is a first, so thanks for having me on. Really,
Pleasure.
really excited.
Fantastic, my friend. And I think Linda's joined here, so it's exciting. So tell me a little bit more. What is happening in your circle of influence at the moment with everything going on with rates, the global factors? I'd love to know your snapshot.
Yeah, I think obviously inflation's the main factor at the moment. So that's obviously feeding through into higher mortgage rates. And as you know, the only way you're going to get a good deal from your bank is to negotiate. So you need to talk to a qualified financial planner, but also mortgage broker. So that's one thing. The other thing is just with the volatility that's been around, you've probably seen it through your superannuation or your investments, etc. So there's been a lot of negativity over the last, probably since the start of the year. But
Yes.
it does look like things are starting to pick up again. Everything that we've seen, whether it be Ukraine, supply shortages, whatever, are all baked into the cake.
Yes.
Unless there's another event coming out of left field, it's a lot more positive than what it was going back a few months. That's for sure.
Oh, for sure, for sure. Now, obviously, the financial planning world in itself has had a bit of a mass exodus. And I guess the financial planners that are left, would you say, are quality ones like yourself? I'd love to touch on that because everyone's just heard that my financial plan doesn't work in the industry anymore. I'd love to get your thoughts on where it is in the current market.
Well, there's definitely good ones, like any other industry. There's some bad ones. But look, I think I've always said that I'll be the last guy standing. So, and I'm a certified financial planner. I've got a master's in finance. I've done all the qualifications. So, unlike others, there's nothing that I need to do. I'm not saying you have to use me, but if I was to recommend you to a financial planner, the first thing I would look at is what the qualifications are. Are they a certified financial planner? Have they been to uni? That's always a great starting point.
Shout out to anyone who's been to uni and non-uni, of course.
Yeah, but some of them. There was a study once that hairdressers were better qualified than most financial planners. So I'd definitely be looking at qualifications, and you can tell pretty easily up front if they get in contact with you and they're not a set and forget sort of guy. It's something you want to look at. Hands-on experience, really, giving value to the client rather than the olden days where they'd sign you up and that's the last you saw of them. So yeah, qualifications and also being on your side and being there, definitely.
No, it's a good point. Many cogent insights that you make there, John. In terms of our clients, everyone knows, obviously, we're Legal Home Loans. We deal with lawyers day in and day out, barristers, partners, PAYG and firm owners. We usually find, because lawyers are risk-adverse beasts in general, they look at the rain clouds beyond the rainbows. And so we find that when we're having a chat with our clients and say, hey, once we submit the application or we're formally approved, we say, hey, you've just been approved for $2 million and we're about to settle on this shortly. Have you got a plan if, touch wood, something were to happen to you? Now, shout out to my friends at CBA who have what's called compassionate care, and they're the only bank that do it. This is not sponsored by CBA, but they will pay your loan for 12 months, which I'm sure is not enough, but you don't have to pay it back. What would you say is the best time for someone to reach out to someone like yourself to get the advice?
Yeah, well, I think where you're leading there, Cullen, is around insurances. So,
yes,
look, as soon as you put in place a significant amount of debt, if something was to happen to you, like you point out, you may not be able to make those repayments. So, income protection is vital. So you can cover, 70% of your current salary. If you're a partner and you're essentially going to receive partnership distributions, they may take some of that off the actual calculation, but you can get 70%. So that's one thing. The other thing is that we always recommend life insurance and what's called total and permanent disability insurance. So with that, you definitely want to take out as an absolute minimum the amount of debt that you have. So in that case, if anything was to happen to you, the house would then go unencumbered to your partner. So you don't want to be leaving debts and they're essentially out on the street. So highly recommend insurances. The other thing, and obviously we're talking to lawyers here, the other thing is estate planning. Just making sure that, your powers of attorney, your wills, whether it's a trust, all that is up to date. That goes hand in hand with the insurances. So just to make sure it's all in the most efficient manner. So, but I'm sure most guys on this call know that already anyway.
Of course, the people watching there, John, they'll be obviously professionals, lawyers, my network. And, they've all heard stories about financial planners just selling them properties in Queensland. Do you think that's now a thing of the past, given that we've had a mass exodus of those type of nefarious characters?
Yeah, you'd hope so, because you probably wouldn't want to be investing in Queensland property at the moment. But given the way rates are going, and you would have thought they'd be the first ones to go. But look, it came back to your earlier question about qualifications. So look, there's a time and a place for every investment. So there's absolutely no doubt that with the guys on this call, an investment property
and girls, guys and girls.
Yep, I'm using that generally, but investment properties should form part of a well-structured portfolio. So there's absolutely no doubt about that. And with the borrowing capacity that you have, I will definitely be looking at quality investment properties. Having said that, there's also a place for managed funds and superannuation and ETFs and the like. But an investment property is probably something that should be at the forefront of your mind, given the borrowing capacity that you've got.
Makes sense. Well, on that point of assets, outside of the typical partnership and family home, what should people be considering, or what should be on their radar for people tuning in?
Yeah, it's an interesting question, but just to go back slightly, I do advise a lot of lawyers currently. So. Yes. And there's basically two schools of thought. And, for one reason or another, a lot of lawyers, or these are partners in major firms, think they only need two assets, the family home and the partnership distributions. That's all they want. They don't want to talk about other stuff. Whereas I guess it's the younger crowd that are more into the investment properties, which, as I said, is definitely a component. Superannuation. And then as time goes on, no doubt you're going to be, let's say you've got your home at the moment, you're going to be paying down the debt on the home.
Yes.
But at the same time, you're also probably getting a pay rise. Some of the numbers I saw in the last rounds, 20, 30% sort of pay rises. So debt's down, income's up. You need to invest that excess cash flow. So again, that's where we come in, whether it be, again, an investment property or managed funds or shares. So that it's all part of a diversified, well-rounded portfolio that you should be looking at.
No, cogent insights again that you're making there, John. And we've already got some comments. Evelyn Gardis has got a smiley face emoji. Thank you, Evelyn. And we've got Michael Salvatsis who says great information. So let's keep it up. Now, obviously, you and I deal with partners and barristers, technically self-employed, sole traders for the barristers, incorporated practices for the partners, and they've got trust distributions up the yin yang, etc. Both seem to spend their money. A generalization. There are some sensible lawyers out there, but many spend their money 3 times. When they get the brief, when they do the work, and the money hits their bank account. And many have tax debts up the yin yang and things like that. How would you advise people that are self-employed professionals manage their money? Is 50% to the side a very balanced strategy or very prudent strategy? What do you say to your clients who want to get ahead?
Yeah, I think the absolute, and this comes back to that old fable, the richest man in Babylon.
Love that. George S. Clason, Jim Rohn talks about it.
Exactly. But I think the absolute minimum is 10%. that you need to be investing. So, and that was straight out of that book. And I think that's, tried and tested over the years. So that 10%, but again, if you own your family home, limited assets, you should be investing, who knows, could be 60, 70%. And again, that could be into managed funds and property. So there's no way that you should not be putting money away for your future. The partnership is great, and you're all doing obviously fantastically, and
Yes.
well educated and smart and all that sort of stuff. But that's not the end of the story. You need to be putting that money away for the future. So it's great advice, Colin. Just save as much as you can. That's the bottom line.
Not financial advice on my side. We don't give financial advice, but people like yourself, accountants, can. So making that very clear. But on the note of cash flow, how can people use excess cash flow, disposable income that is just sitting there? I've got a lot of clients with term deposits and large sums sitting in their offset accounts right now.
Yeah, and I think it comes down to the notion of a diversified portfolio. So again, I sound like I'm probably repeating myself, but again, there's those specific asset classes that you could be looking at. So I think I can guarantee you that in 10 years, the stock market will be a lot higher than it is today. I absolutely guarantee that. But is it going to be higher tomorrow, or is it going to be higher in a month? I've got absolutely no idea.
Your crystal ball is broken, John. Your crystal ball is broken.
But I can tell you it's going to be higher in 10 years. So look, if you do what's called dollar cost averaging, so essentially...
dollar cost average, what is it, John? Tell us.
Dollar cost averaging is where essentially you buy a certain number of managed funds or shares every month into, let's say, I don't know, for the next 5 years. So one day you might be paying $10, the next you might be paying 11, the rest you might be paying 9, but you're going to get the average over that period. So it's not going to knock you around if the market goes down, and conversely, if it goes up, you're paying at a higher price. But that way, you're getting the average price, and you can, again, be guaranteed in 10 years' time that you're going to have a significant balance, whether it be any of those assets. So just stick it away and put it into quality investments. That's the idea. And I guess that's where we come in. There's lenders that can tell you what the right mix is. In terms of what I do, a lot of it's around the wealth creation side. So it's how to invest that. It's how to get the most, tax, how would you put it, tax-friendly environment, whether it be superannuation or trusts or the like. So really, it's, just investing for the future.
No, I'm endeared by what you're saying there, John. In terms of superannuation or SMSF or self-mismanaged super, which sometimes is the case, how would you go talking about that chestnut? I know we're going to be opening some cans of worms there, but I'd love to know your thoughts on that.
Yeah, and it's horses for courses again. So look, if we're talking to a 25-year-old partner, locking money up for the next 40 years is going to be different to someone that's let's say 50. When he doesn't know what to do with his cash. But you should be squirreling away as much as you can into super, no matter what your age. So at the moment, you can put in $27,500. So if you're on a salary of $275, there's nothing more you can put in on a pre-tax basis. So you've already hit the limits. You can make after-tax contributions, but again, that may well be better placed in an investment property or other assets. So it really comes down to age, your risk factor, and all that sort of thing. But there was an interesting article, I think it was yesterday's Financial Review. There's now over 80,000 Australians that have over $2 million in their super accounts. So
wow.
when you let's theoretically say that they're earning 10% on that money, instead of paying tax like you guys are at 50% in the dollar, they're paying 15% tax. So essentially, they're saving 35% tax on that. Let's call it $200,000 of earnings. So instead of paying whatever that is, 100 grand in tax, they're paying 30,000. So you can see how powerful it is from a compounding perspective. So you've got to get in the minimum 27,500. That's a done deal. What you do after that is, I guess, is specific advice, given your circumstances.
In terms of the voluntary repayments and whatnot, should anyone in their 20s or early 30s be considering this strategy, or would you say it's more sort of an eldest type strategy as you get along in your career in law?
Generally speaking, for the majority of people, it's more for the elderly. But with your cash flow, let's say, I don't know, you're 30 years old and senior associate, or maybe just made partner.
Congrats.
If you're doing really well, if you've got money, you don't know what to do with it, you could be utilising that after-tax contributions, that $110,000. So again, I wouldn't recommend that to the guy in the street, but if you've got sufficient cash flow, it's got to go somewhere. It either goes into an investment property where you're paying, it might be cash flow neutral. It goes into investments where you're going to pay 50% on the earnings in tax, or it goes into super where you pay 15%. So what I think will happen, and without picking on political sides, there's a highly likely chance that the current cap that you can get in of $1.6 million, that's going to get watered down over the years. So sooner you get it in, the better, because you can see the parties already thinking, look, this is just too good to be true. These guys are paying 50% tax and they're getting away with 15% in super. So it's pretty powerful, to say the least.
No, definitely powerful. And two other people who think it's powerful. We got Linda Fernandez tuning in saying, great advice, looking good, both of you. So there you go there, John. And we've got Julian McGrath saying, very good advice, John. So keep it up. I want to keep on this train of super, because a lot of clients, my clients out there, know that they have insurances in their super. Life insurance, TPD, sometimes income, not usually the case, but sometimes. And there's that argument, do I stay with my super company and increase the premiums I'm paying to cover myself, or do I just cut the losses and then come to someone like you and get specialist advice? And hand on heart, myself, I did the same thing. I ripped it out of my super because I'm in a different position. And I've got my advisor who's done the same thing and got a personal insurance on myself because I'm a business. I'd love to know what your thoughts are on that, John, with, say, the different types of clients, those in the firms that are PAYG, those that are partners, and those that are barristers, because they're very different people.
Yeah, well, I'll start with income. I'll start with life insurance. So that's the easiest one. You pass away, you get paid out. So the quality of the different policies, whether it be inside super or outside super, is pretty standard. So you're not going to lose much either way. TPD, this is the big one. So this is where you're totally and permanently disabled. And there's been a lot of case law on this recently. So with the super funds, you can only have what's called any occupation. So the better qualified you are, the harder it is, believe it or not, to actually claim under that policy. So with any occupation, let's say, you're a criminal specialist or whatever. The theory that these insurance companies have is that, look, you might not be able to work tomorrow as a barrister or a partner or a senior associate, but because you've got 2 degrees, there's no reason you can't go back and lecture at uni, for example, or there's no reason you can't get a job as a company secretary. So it's pretty far-reaching because you're so well qualified. It's hard to argue that, look, I can only be a lawyer. So that's what you get when you're in super. You just get that any occupation. So what you can have outside of super is own occupation. So as an example, I've done a lot of cochlear implant specialists. So if they get the slightest, wobble of the hand, they can't operate. So that would then qualify as a payment under an own occupation. They can't work as a cochlear implant specialist. For a barrister, if you can't appear in court, you get paid out because that's your job, to represent clients. So there's a massive, massive difference between own occupation outside of super and any occupation inside a super. If you're a labourer, there's no difference. But if you're highly qualified, lawyers, doctors, and the like, it's just so difficult to actually claim under a TPD policy in super. So I would definitely, for that reason, move it outside super, because I'll be realistic, you're not going to get paid. That's the reality, unless you're severely disabled. But in most cases, it's going to be because you can't do the job that you're trained to do. So that's that. With the other big one is income protection. So it does vary depending on whether you're a salaried partner or senior advisor or senior associate, or whether you're part of let's call it the inner sanctum of the partnership and the distributions and the like. So what they do is they actually will have an offset clause in most of them. So let's say that, your normal salary was, just make a number up, $500,000. If that was to reduce down to $200,000 because of, you're still receiving the partnership distributions in that situation, they'll only calculate the benefit on that $300,000. So that'll apply, to most partners. Senior associates and salaried partners, because you're not getting that 200 grand, you can claim the full amount. So a big difference depending on, where you fit in the hierarchy within a law firm. So as to how you can structure that. So yeah, definitely. But as I said, the main one I'd be concerned about is TPD.
TPD.
Really. Yeah, where you're totally and permanently disabled. But as I said, it could be that you've got a hand flicker as a cochlear implant specialist. That would then qualify. You can't do your job, as an example. So,
my goodness,
a lot of case law on this concept of any occupation.
I'm sure recently. There's someone who can tell me the name of the judgment. Put it in the comments if you've got that, guys. It sounds to me, being in the super, and I'm not scaring anyone, but Michael Moore came out with that brilliant documentary it's called Sicko, on the American healthcare system, where there's people that actively look as part of your insurance to see how you can disqualify you. Are you saying, John, and would you accept that the super companies are doing that? Or if someone went through someone like yourself, they have a better advocate on their side, so these insurance companies aren't looking for ways to not pay you? I'd love to get your thoughts on that. Opening another can of worms, I know, and there's probably some insurance lawyers.
It's a hard one. I actually do know insurance barrister, Luke Morgan, very well. We're actually
shout out to Luke.
Hopefully you're there. But we were talking about this last week, and to say the old case of the bricklayer that's got the bad back. In a lot of cases, they do still put the guy there with the camera, trying to find out if that's the case. So I don't think that's specific to super. I think it's just specific to the industry. There's certain red flags that they look at and the like. But you're right. They will test it to see if the theory that you're disabled is actually correct, or whether you can return to work. So
yeah.
And one other thing on that. Yeah, just with income protection, there's been a real change in the last 2 years. So what they're trying to do is they're trying to get you back to work. So, it's not just about the fact that, they've got to pay you a benefit to your age 65. It's also about quality of life. None of us here, I'm sure, want to be sitting on a couch all day doing nothing.
No one does that. No one would want to do that.
Because we can't return to work. So they've seriously increased the amount of benefits under the new policies, with income in particular, to get you back to work and get you functioning as a human again. So, which I think is great. So it's all about that, getting back to work and feeling better about yourself, sort of thing. So definitely.
No, I concur. Like, if people want to be active and do what they love and get back to it, I think you're right. On the testing process, because people that take their, their own personal wealth to another level and start to get into this realm of personal insurance, etc., they don't know that you get a health check as part of it. People actually health check you. Someone actually came to my house 5 or 6 months ago to do that. So I'd love to know your thoughts on, do people get in shape before that? What can they expect as part of that health check when they want to get
Yeah, so
insurance and whatnot?
that'll only cut in at $1 million of life and TPD. So below that, you won't need to do a blood test or a physical. It's only once you get above that. So I guess we're talking about everyone on this call. There's not much you can do really, because it's the main one is the blood test, and that they take into account what's called a your body mass index. So I think that goes up to 34. So what that means is you can be not obese, but you can be pretty big and still get insurance. So you should be okay, providing you haven't had a trauma event. You should be fine going through this process. The other thing I should mention is that, just back to the super, so lawyers are rated AAA. So essentially what that means is when they work out the premium, there's about a roughly 20-25% discount to what the man on the street would get. So you're getting a massive benefit being a AAA rated risk. It's highly unlikely you're going to fall down the stairs at work, for example, compared to the labourer down the street. So they're all competing for you guys when it comes to insurance. So it's some massive differences in premiums, and everyone wants those lawyers because they're great clients at the end of the day. It's a bit like, Cullen, on the lending front. So
yeah, look, I would say legal clients and professionals and whatnot, the banks and everyone would love to bank them as clients. I would say dealing with legal professionals is fantastic, but you do have to know your stuff, because lawyers, as I said, are very intelligent people, and they will do their homework, and they expect top-notch service. So
exactly.
If you are going to get into that space, I definitely encourage you to obviously be on your best game and whatnot, and make sure you're giving the information as to how you arrived at your decision, etc. And that's a great segue. What are the benefits, I would say, for legal professionals and allied professionals and those that are tuning in to getting a good financial advisor like yourself? What should people be looking for? What are the flags, and I guess all those things, benefits, flags, what should they be looking for?
Yeah, and again, I think it comes down to the quality of the advisor. So you definitely want a certified financial planner. You're not going to use a lawyer that doesn't have a degree, for example. So you want someone that's highly qualified. You also want someone that is within a good licensee. So, for example, I'm with Lifespan Financial Planning, which is probably about 150 advisors, but not once have they been referred to ASIC, and they weren't mentioned at all during the Royal Commission. So you want someone that's highly qualified within a really good organisation. But again, what I'd be looking at is, references and, Google reviews and all that sort of thing. So there's some really good advisors out there, but as I said, there's also some pretty ordinary ones. So it's just a matter of doing your homework. And again, it comes down to how well connected they are as well. So, I'm sure that, Cullen's not going to put someone on here or anyone else that's not highly qualified. So again, it just comes down to the experience and how they interact with clients. The main thing is you want an advisor that isn't just going to see you, put your insurance in place and say, see you later, mate. That's the end of the story. So you want someone that's on your side. You can call him any time of the day. You can discuss anything. He's qualified against the estate planning. He can do whatever, superannuation, investments, the like. So I think that's one thing you want. The other thing that I guess Cullen and I both do is, and I guess in both our situations, it's a deliberate choice. We just do what we're good at. So Cullen just does mortgages. I just do financial planning. You see these other firms out there, they try and do your accounting, they try and do your mortgage, they try and do your insurance, they do your investments. My view is you can only be good at one thing. You can't do everything.
Stick to your knitting.
So, exactly. So
I agree.
I'd be using someone that specialises that isn't a generalist. You know, oh, one day I can do a mortgage, the next day I'll do a bit of insurance. You just want someone that knows and is across all those different or specific areas. I think that's what you want.
Oh, totally agree. And look, I can say a first-hand example. You know, we're very big on offering value to the top tier law firms out there, and we're part of their staff benefits of many large firms. And one of the conversations that came up, and the reason why they're reaching out to us, is they've engaged one of these firms that do everything, and they've found that the mortgage side of things is suboptimal. In other words. So they've come to us saying, you guys are specialists in legal. We'd love to add value to our employees like that. So, you know, I'm willing to be proven wrong. And I'm sure there are some reputable firms that do everything well. But I'm with you, John. You stick to someone that knows what they're doing. We're not going to open any accounting businesses or financial planning anytime soon. We love dealing with lawyers, and we love finance as a means, loans, commercial resi, asset finance, and that's what we do. And we're not going to try and be something that we're not. An original is worth more than a copy, John, as Oscar Wilde would say. Shout out to Oscar. I'm sure if he'd be alive, he'd be putting some questions on super and investing. And look, here's one for you there, John. A lot of my clients, more the millennials, are coming with their accounts in stockpot, crypto, and all these things. What's your view on cryptocurrency and where it's going as part of a balanced portfolio?
Yeah, I think it's not an easy question, to be honest. But
no, we never ask easy questions, John. Come on.
I think all I'll say is that, and it's been proven, especially over the last year, there's a very high correlation between Bitcoin and interest rates. So if you think interest rates are going higher, if you think rates are going higher, I probably wouldn't be touching Bitcoin. If you think rates are coming down, I'd probably pile into it. So there's just a massive correlation between that and also interest rates. So really, at the end of the day, it's a call on interest rates, and it's also a call on inflation. So you could probably answer that one better than me, you know, in that case, given rates and the like. So look, if I was a betting man, I'd probably say it's going to rally a bit, crypto, but at some point the reckoning will come once, you know, rates are fully factored in. So, but certainly that's not advice, that's for sure.
No, definitely not. I've got a colleague of mine in the industry, a lawyer, seems to always buy when it's high and sells when it's low. I'm going to get him a T-shirt. Buy high, sell low. I certainly, you know, call me old-fashioned, but I wouldn't be buying land in the sandbox at the moment. I'd probably rather, you know, buy real land than virtual land. No, of course. So you're talking about the metaverse, are you, John? Are we
getting metaverse,
into that, the meta conversation? Interesting.
Yeah, I think I'd rather be buying real property than metaverse property at this point.
No, of course. We only deal with real land here, so no, it's a good point. In terms of, I guess the process and how it starts, because a lot of my clients I know are time poor, time sensitive. They barely have 5-10 minutes to speak to me during their day. How long does a session take? What's the process? And there's yearly reviews. You know, let's unpack that.
Yeah, and that is the issue. And at times, to be honest, I do struggle with clients. A few barristers just trying to get their mind focused is probably the best way of putting it. So, look, generally speaking, to start the process, there would be 2 fact finds. So essentially that just goes through where you are today, what you want to achieve, and how we're going to get you there. So it'd be really, you know, two meetings just trying to find out where you are. So you'd probably say they would go for about 45 minutes, both those meetings. Then what happens is I go away, I come up with some sort of draft strategy. It could be, look, we'll make additional contributions to super. We might recommend certain investments, might recommend a certain amount of insurance based on that own occupation category. So we'd come up with a draft advice document. If you're fine with that, we then go away and prepare a statement of advice. So that statement of advice would then give a valid reasoning as to why we've made those recommendations. So once that's done, generally speaking, anytime we're talking about investments here or superannuation, anytime there's a major event occurring. So it could be interest rates going up, it could be Ukraine, it could be lockdowns in China. We'll be in touch to explain that situation, but also to see if we need, which we do quite aggressively, change the portfolio. So what we did was, in April, we significantly reduced the risk on all the portfolios, knowing that interest rates were going up as a result of inflation. So that means getting in touch ASAP to try and get attention to de-risk. So at the moment, we're probably looking to put more risk back on, given we're below where we normally would be. So it's a constant process on the investment side. So it's not like, we'll just sign you up and never see you again. Every time there's a change, we're involved. On the insurance side, Cullen's already said this. Basically, you need to sit down, you need to do what's called a tele-interview. They'll ask you, do you smoke? Do you jump out of planes? What's your family history like? All that sort of thing. They'll then probably want, because of the amounts we're talking about, they'll probably want a blood test, and they'll probably want, if there's been an incident, they might want a short form medical. So that's the hard thing. That's really it. It's really the 2 fact finds. It's the presentation of the statement of advice, and it's on the insurance side, it's sitting down with you and just getting it through. On the investment side, it's a bit more full on. It's, we need to get in touch, and this is why we want to, because it's real money at stake. So yeah, we definitely need, I know you're busy and I know that, but we definitely need to be in touch. So to get things done in a timely manner, because back in April, we were seeing 5% falls every day. So, the longer we left it, the harder it was. So yeah, it's an ongoing service agreement, essentially, where we are in touch to make changes to your portfolio. So, but it also changes because your circumstances change too. So, talking to a few partners that might be moving to New York or London, that makes a significant change. It could be, that, your wife's pregnant or whatever else is the case. So it's not a set and forget. So we do need to be involved. It's not as simple as you just go and work it out for us and we'll never see you again. So it is pretty intense, the process. Sorry, Cullen, I didn't miss all that. Sorry, Cullen, you've gone in the voice department. Do you want to put it in the chat or? Sorry, Cullen, I just can't hear you. Oh,
I think I pressed the mute button, guys. Be careful when you're using one of these Yetis. You may hit the mute button and no one can hear you. So I love that. What I was saying, John, how can people find you, mon ami? Where's the best place, to have a coffee with where are you hanging out these days?
Yeah, so based in Martin Place in Sydney, but look, I'm happy to go anywhere around. It's not that far, is it, to the law courts? But probably the best place to get me is on LinkedIn. Simply just John Walker at Optimal Wealth. So that's probably the best. If you wanted to email me, it's just simply john@optimalwealth.com.au. So look, I'm more than happy to talk to anyone. It's obviously, no obligation, all that sort of stuff. Just to see if there's anything we could add value for you. So that's really what it comes down to.
Well, I've just put your email in the chat there. Thank you so much for joining us there, John.
Been a pleasure. It's been good. And I think, if anyone's interested, we do monthly webinars as well. So a few of the people on here, we've done them on mortgage broking, obviously with Cullen, estate planning, superannuation investments, ethical investments. So the one we did last week was on divorce and the law. So if anyone's ever interested, more than happy for you guys to join us on that education piece as well. Trying to do trying to keep up with Cullen, I guess.
It's elevation through education. I love that. So I will make sure everyone can loop up in with you, John. Thank you so much again for joining, mon ami.
Yeah, thank you, Cullen, for having me, and thanks everyone. I know it's 1:30 in the afternoon, so you're all busy. So thank you very much. I do appreciate it.
Absolutely. Thanks so much, John. And if you want to catch us again on Lawyer Lending Live, we come out every Wednesday, LinkedIn, YouTube, and Facebook on Wednesdays, every Wednesdays. Bye, everyone. Have a great day.